Settlement risk in banking, exploring risks and processes in financial transactions. Agenda. Introduction to settlement risk. The settlement process in banking, clearing and its role in settlements, mitigating settlement risk. Definition of settlement risk. What is settlement risk? Settlement risk is the risk that one party in a transaction fails to meet their obligations, resulting in losses. Causes of settlement risk. This risk can arise from operational failures, technology issues, or market volatility that disrupts transactions. Impact on transactions. Settlement risk can lead to significant financial losses and impact the trust between parties in a transaction. Types of settlement risk. Principal risk. Principal risk occurs when the counterparty fails to deliver the asset as agreed, exposing the party to potential losses. Timing risk. Timing risk refers to delays in the settlement process, which can impact the transaction's overall value and profitability. Importance of managing settlement risk. Maintaining liquidity. Proper management of settlement risk helps ensure that financial institutions maintain adequate liquidity to meet their obligations. Regulatory compliance. Adhering to regulatory requirements regarding settlement risk is crucial for financial institutions to avoid penalties and maintain market integrity. Reputation protection. Effective risk management safeguards the reputation of financial institutions by preventing costly errors and maintaining trust among clients. Overview of settlement process. Confirmation of trades. The first step in the settlement process involves confirming that all trades executed are accurate and agreed upon by both parties. Transfer of funds or securities. This step involves the actual transfer of funds or securities between the involved parties to complete the transaction. Reconciliation of accounts. Final step ensures that all accounts are reconciled and that both parties have fulfilled their obligations in the settlement process. Key participants in the settlement process. Banks. Banks are crucial in the settlement process, providing financial services and ensuring the secure transfer of funds. Clearing houses. Clearing houses act as intermediaries between buyers and sellers, ensuring smooth and accurate settlement of transactions. Brokers. Brokers facilitate trades between buyers and sellers, playing a key role in the efficiency of the settlement process. Custodians. Custodians safeguard assets and ensure accurate record keeping during the settlement process. Steps and timelines. Trade execution. The initial step where trades are executed based on agreed terms, initiating the settlement process. Confirmation process. Following execution, the trade details are confirmed to ensure accuracy before moving to settlement instructions. Settlement instructions. Specific instructions are provided for the settlements, detailing how and when the assets will be exchanged. Final settlement. The last step where the actual exchange of assets and funds takes place, completing the settlement process. Definition and importance of clearing. Understanding clearing. Clearing is the process of reconciling purchase and sale orders to ensure accurate transaction settlements. Reducing settlement risk. The clearing process helps in minimizing settlement risk by ensuring that all transactions are properly accounted for before settlement. Clearing houses and their functions. Role as intermediaries. Clearing houses serve as intermediaries in financial markets, facilitating transactions between buyers and sellers. Risk management. These institutions manage and mitigate risks associated with financial transactions, ensuring stability in the market. Transaction settlement. Clearinghouses ensure the smooth settlement of transactions, confirming and finalizing trades between parties. Clearing versus settlement. Definition of clearing. Clearing encompasses the preparation and confirmation of transactions before actual asset transfers take place. Definition of settlement. Settlement is the final step where the actual transfer of assets and funds occur, completing the transaction. Importance of both processes. Both clearing and settlement are crucial for ensuring financial transactions within markets. Risk management strategies. Thorough due diligence. Conducting thorough due diligence is essential to identify risks before they materialize and ensure informed decision making. Robust internal controls. Implementing robust internal controls helps to prevent and detect errors, fraud, and compliance breaches effectively. Regular risk assessments. Regular assessments are vital to evaluate the effectiveness of risk mitigation strategies and to adapt to emerging risks. Role of central counterparties. Managing settlement risk. CCPs are essential in managing settlement risk by ensuring that trade settlements are guaranteed and efficiently processed. Counterparty exposure reduction. By employing netting processes, CCPs significantly reduce counterparty exposure, enhancing overall market stability. Regulatory frameworks and compliance. Importance of compliance. Compliance with regulatory frameworks is crucial for managing settlement risk effectively in financial institutions. Regulatory guidelines. Financial institutions must adhere to specific guidelines set by authorities like the Basel Committee to maintain stability. Stability and trust. Adhering to regulatory frameworks fosters stability and builds trust between financial institutions and stakeholders. Best practices in the industry. Regular staff training. Regular training sessions for staff improve skills and enhance their understanding of best practices in the industry. Effective stakeholder communication. Fair and effective communication among stakeholders fosters collaboration and understanding, reducing risks in the settlement process. Continuous process monitoring. Ongoing monitoring of the settlement process allows for timely adjustments and minimizes potential risks associated with settlements. Conclusion. Importance of settlement risk. Settlement risk is critical in banking, necessitating careful management to mitigate potential losses. Effective management processes. Implementing effective processes is essential for managing settlement risk and ensuring financial stability. Learning from experience. Financial institutions must learn from past experiences to enhance their risk management approaches. Thank you.